appreciate you guys all joining us today. I made a remark in setting up this Wealth Wednesday that this is one of those things that people are very likely to not watch this video and kind of scroll past it and kind of like in the picture here, kind of feel a little bit uncomfortable and just kind of move past it. For being here today, I think you're going to take a lot away from this one, and hopefully a lot of you that have already been working with us for a while, and even a bunch of you that are not working with us right now, you've probably already have 2 or 3 of these things that you've already addressed on your own, but that doesn't mean that there's not going to be a lot of good information in here, specifically around one of the uncomfortable conversations that we're going to have. I think is going to be surprising that we think it's an uncomfortable conversation, but the other ones kind of around aging, end of life, different things like that. I think it's going to be a little bit more obvious why those conversations are so uncomfortable. But like we said in the title here, you really need to have these conversations, not just with yourself, not just with your spouse, not just with a planner or advisor or, estate planner or accountant or all those types of people, but also with the people in your life, whether it's heirs or charities or, schools or whoever's going to end up benefiting from your nest egg and the value that you've accumulated and the wealth you've put together. You really need to have these conversations with them as well. So I want to contrast those hard conversations with some of the easier conversations. So if we sit down to meet with somebody and we start talking about something like investment performance, how to grow your money faster, tax reduction, how to pay less in taxes to the federal government, state government, or even like when you're going to retire, maybe how to accelerate retirement, how to retire earlier, how to pay less out in terms of healthcare costs and various things like that, even charitable gifting, how to get more money to those charities and other organizations in your life that you care about. A lot of times what we find is that these are fairly easy conversations. I mean, they're not as easy as, talking about your favorite television show or talking about your favorite hobby. If you're really into woodworking or something, it's probably a lot easier to talk about that. But these conversations, at least when it comes to financial planning, these are kind of some of the easier ones. And I know they're complex. I'm not saying they're not complex. The tax planning and all the stuff that Eric's shown you guys on a whole bunch of his awesome Wealth Wednesdays. I know it's complex, but you're much more likely to stick through a complex topic if it's about how to save money, how to pay less money in taxes and different things like that. Today, we're going to talk about some harder conversations, some more uncomfortable conversations. And the first one of the hardest conversations to have with a new client is predictions. And what I mean by that is not, kind of crystal ball type predictions, but like market and economic predictions. We find that a lot of people make some pretty drastic moves in their retirement planning and their financial planning that are based on very rigid predictions about what they think is going to happen in the world, what they think is going to happen in the economy, what they think is going to happen in markets. And what I'm going to show you, hopefully through this presentation here and some of the statistics that we have, is just how difficult it is to accurately make economic predictions. And the facts here, people are terrible at predictions. Okay. I'm not saying, clients are terrible at predictions. I'm saying human beings are awful at predicting things. We're awful at predicting the future. We are especially terrible at predictions in complex systems. So think about a complicated system like the economy. Okay. The economy has hundreds of millions of moving parts, literally hundreds of millions of participants, different businesses, different, price impacts, all sorts of different effects, shocks to the system, different things that can happen. It's an extremely difficult thing to predict. And the stock market is maybe one of the most complicated, complex parts of that, because you take this economic machine that's already the most complicated thing there is, and now sprinkle a whole bunch of human psychology on top of it. And now you have the markets. So take that complicated, unpredictable thing, make it a lot more complicated and unpredictable, and you get the stock market. And when we look at just the economy, we're going to start here, then we're going to move into more of the investment side of it. But when we look at just the economy, economists, so these are the people that are like the top experts, PhDs in their field, Ivy League educated, all those types of people, the talking heads that you see on the different news outlets and things like that. There's a study that the IMF did, came out back in 2018, and the study was pretty simple. It says, how well do economists forecast recessions? So they looked at 153 recessions in 63 countries. They compared it to predictions. The results of this study, if you want to read it, is that the vast majority of these recessions were missed, completely missed. There's also an old line that economists have successfully predicted 46 out of the last 7 recessions. It's very hit or miss, and really a lot more miss than anything else. So why is that important? Again, these people are the smartest, brightest, most highly trained, most educated, most experienced people in the economy, and they have no idea what's going to happen. Okay. The reason I bring that up and the reason it's such a hard conversation is because if you are absolutely convinced that the economy is going to completely collapse, okay, your prediction is more likely to be incorrect than their predictions. Their predictions are super inaccurate. So like what I'm getting at is, don't base your financial plan off something that's a 1 in a million shot of success. Base your financial plan on something much more sound, something much more objective, something a lot more of a track record, which basically is not predictions at all, but essentially run various different scenarios. Look at if the market does good, if the market does poorly, if the market's choppy, if taxes go up, if inflation goes up. Look at all different sorts of scenarios. And a real plan is not a prediction. A real plan is something that is okay in any scenario that unfolds. That's a real plan. That's I have some friends that were in the military, and they said, you don't go out on an op with a plan A. You have a plan B, C, D, E, F, G. You have a plan triple C. You got to have all sorts of options and check downs and ways to adjust on the fly based on what's happening out there. And that's really what you should be doing in your financial plan as well. You shouldn't make a prediction and say something like, I'm going to buy when the S&P is below 3,000. What if it's never below 3,000 again? That means you're just never going to buy. You're going to sit in cash forever. Inflation's running at 5.4%. Okay, that means if you're sitting in cash and you're dribbling away 5.4% of your net worth that's in cash to inflation. And by the way, did you predict 5.4% inflation? Because a lot of people didn't. Okay, and let's move on here. So this is getting into more of the market realm. Harry Dent, he talks about here, the US has gone over the demographic cliff. Markets are going to crash this summer. This guy has a pretty good track record, by the way, of predictions. He had some great predictions back in the 80s and 90s. The great boom ahead in 1993 was his big prediction. Jobs, 1995. 2009, he wrote the Great Depression ahead, different things like that. But look at when this article came out. It's probably a little blurry on your screens here. January 8th, 2013. What has the market done since January 8th of 2013? It's ripped. It's absolutely surged. There have been some pullbacks. It's got a little choppy in 2015. There was that Christmas pullback in late 2018, and obviously the COVID pullback in early 2020. But I would say that his prediction about the markets going off a cliff, a demographic cliff, I would call that a massive failure. And that's a guy that has an extremely good, historically, if you look at his last 4 or 5 major predictions, they were quite good. But he's been calling for a crash since 2011, and it just really has not materialized. So you don't want to bet your whole life savings, your whole future, your legacy, your heirs, what they're going to inherit, what's going to be left for your spouse, for your husband, for your wife. You don't want to bet that on your ability to forecast this stuff when some of the best guys out there, Ray Dalio has been calling for a crash for years and years and years, and he's managed tens of billions of dollars in the hedge fund space. It's just difficult to do. And right now, if you bet on a crash, if you say, I'm holding out, I'm waiting for the market to crash, you're literally betting against 500 of the brightest business minds in the world, actually thousands of them. You're betting against 500 CEOs, 500 chairmen, chairwomen, 500 chief operating officers, 500 chief technology officers. And that's just if you're looking at the S&P 500, but you're betting that Coca-Cola is not going to sell Coca-Cola. You're betting McDonald's is not going to keep expanding. You're betting on a lot of things that historically just haven't materialized, even for people that have had good records at making these predictions. So again, don't base your financial future on your ability to make predictions. One of the most notorious areas when it comes to predictions is the investment newsletter industry. So Mark Hulbert has this awesome thing you can go look up. It's Hulbert Financial Digest. He's tracked hundreds of newsletters for 36 years. And his main takeaway in an interview towards the end of his career, they said, "What's your main takeaway?" You've looked at all these newsletters for all this time. And he said the most depressing thing was to discover how little persistence there was between the past and the future. So what he means by this is that if your newsletter was one of the top performers, let's say it was one of the top quarter of newsletters over the last 10 years, the odds that it would be in the top quarter for the next 10 years was 25%. It was literally random chance that their ability to predict would stay solid, stay significant. So also, his data from January of 2000, this one's really, really impactful. If anyone watching this is subscribing to a newsletter, I highly suggest you go to Hulbert Financial Digest, go check out the track record of that newsletter, go see how it's doing relative to the S&P, when you adjust for transaction costs and taxes and all sorts of different things like that. But anyway, starting in 2000, he looked at 244 market timing strategies. So we're not talking stock pickers, we're talking just ability to time the market. 84 different companies, 244 strategies. By January of 2016, only 77 of those strategies still remain. So the vast majority, 70, 75% of the industry was wiped out. And only 34 of the advisors were still marketing their market timing solution. And he said down here, this is the thing that gets almost funny, is only 7 of the investment newsletters of the market timing strategies. So out of the 244 he tracked, only 7 had a higher return than this rhyme. Sell in May and go away. Don't come back till All Hallows Day. Okay, that's a really old, almost like laughable Wall Street axiom, but he literally ran a study where if you sold on April 30th, walked away, came back and bought on November 1st, over time, you outperformed 237 of these high-end expert market timing newsletters, just with that phrase right there. Sell in May, go away, don't come back till All Hallows Day. And in fact, if you look at the 7 that beat, okay, so over that whole period that he studied there, here's the 7. So it's Timer Digest, The Chartist, Brinker's Market Timer, and Blue Chip Investor. What's interesting, out of that 7, 5 of them still lost more than 40%. Okay, 3 of them still lost more than 50%. So you're not even really reducing your market risk all that much. And look how much they're outperforming by. On that second to last column there is the annualized performance. 2 of them didn't even beat by 1%. And then some of them there, the very best performing one on that list there would be the Timer Digest top 10 consensus, 7.1% annualized return, still lost 44% in a drawdown. So what I'm saying here is like the prediction game for the very best of the best, super selected, getting down to the very top of the tip of the spear, very best, brightest people that are out there, you're getting maybe a couple of points better. And look what you're giving up. You're taking just as much or even more risk than the market itself in a lot of cases. And then, again, this is the very best. This is the best 7 out of 244 newsletters. So keep that in mind. Also, if you look at mutual funds, in my opinion, it's even more devastating. So when you look at the number of mutual funds that underperform their benchmark over a 15-year period, it's over 90%. Okay, they're going to update these numbers here shortly, and they're going to start providing 20-year periods. And let's pick one out. So let's look. What is that? 1, 2, 3, 4, 5, 6, 7 rows down. It says large cap core funds, S&P 500. Okay, so we're just going to compare to large cap core S&P 500 over the last year. 69.5% of mutual funds underperformed the S&P 500. Okay, over the last 3 years, 83.5% underperformed the S&P 500. Over the last 5 years, 94% underperformed the S&P 500. Over the last 10 years, 97% underperformed the S&P 500. Over the last 15 years, 92%. You can see the general trend is that the longer you go, the more likely these funds are to make a mistake. And I think when you start getting into 20-year, 25-year, 30-year performance tracking numbers, what you're going to find is a number like 98, 99% of all mutual funds underperform their benchmark. Okay, that's a prediction. Okay, so you want to take that with a grain of salt, because in the process of this, I'm saying, don't make predictions and things like that. But we know for sure right now that over 90% of funds are underperforming their benchmark. So just think about that. The reason I'm bringing this up is if you're betting your future on your manager's ability to outperform the benchmark, I think you are playing Russian roulette with your financial future. You should not be doing that, in my opinion, unless you're okay with a, 1 in 10, 1 in 20 chance of achieving your goals, which obviously is, not realistic. So let's also go even more advanced here. So this is a pretty interesting chart. This is algorithmic and AI quant-based hedge funds, okay? The blue line is the S&P 500. The green line is equity market neutral index. I think that's a gray line. I'm color deficient, so I think the second one's a gray line, or the third one I should say is a gray line. That's a macro systematic diversified CTA index. That's commodity trading advisors. And then the red one there is macro CTA index. And just look at them over the period going back to 2011. So when we look at the S&P 500 over this period, it was up 90%. All three of these other groups of hedge fund and algorithmic trading strategies were down. Okay. Some of these people manage billions and billions of dollars, by the way. Okay. Now let's look at you could say more flagship type of hedge funds. So these are not algorithms. These are not trading strategy. These are not like quantitative, program trade strategies. These are just, let's look at the hedge fund industry in general. Going back to 2008, the black line there is the S&P 500. The blue line is a fund weighted composite index. Okay, what does fund weighted mean? It means that the larger the hedge fund, the more weighting it gets, which actually is sort of selecting for the best managers through time, because the funds that have bad track records lose money, get money pulled out of them. The funds that have the best track records get more and more applied to them. So this is not even just the average, top 100 hedge funds. This is kind of like the best of the best in the hedge fund world. So just to review this, let's review people that can't beat the market. What have we done so far? We've done economists can't beat the market, newsletters can't beat the market, mutual funds can't beat the market, and hedge funds can't beat the market. These people are all compensated very highly to manage money, right? And they can't do it. These people have entire systems. Like if you look at the hedge fund world, how many billions and billions of dollars are in there, how cutthroat it is, how hard they're looking for talent. The average hedge fund is recruiting from like MIT's physics department and places like that. These are not just, Joe off the street. These are people, the very best and brightest minds out there that just can't do it. They can't beat the market. And well, it's possible. So this is from Charlie Ellis. He has this great book that I highly recommend everybody read. It's called Winning the Loser's Game. He says, well, it's possible to generate alpha, which is risk-adjusted outperformance, and win the game of active management, which is like, picking individual stocks or market timing. The odds of doing it are so poor that it's not prudent to try. And you saw in some of these statistics, the outperformance for the funds that outperform, the very best, the 1 out of 244 that outperforms wins by like 1% or 2%, and everybody else falls behind. It's just not worth it statistically. Okay, so don't play that game. Don't bet your future on this game. Don't bet your legacy on this game. Don't try to do that. Don't try to make those predictions and time things and doing all that yourself. So we're going to move on. That was actually the easiest of the three. Predictions are the easiest of the three conversations, the three uncomfortable conversations to have. So that the next most uncomfortable conversation to have is death. Okay. And I get it. I understand that it's something we don't want to think about. We don't want to talk about, we don't like the idea as human beings. We don't like the idea that we're going to die, but like, you all know the death and taxes quote, like it's coming. It's going to happen. That old, there's a comedian line that it's like, nobody gets out of here alive. It's coming, and you want to be prepared. So you don't just stick your head in the sand. Don't just, hope and hold out some sort of delusion that it's not going to happen, because what's going to happen is the people and organizations around you are going to get hurt if you're not prepared. Okay, so let's talk about this a little bit. The ways to deal with death, the ways to deal with estate planning. Number one, quite frankly, the way that a whole lot of people handle it is they just ignore it. They don't have a will. They don't have powers of attorney. They don't have trusts. They don't have legacy plans. They don't have their beneficiaries set up properly. And the way that ignoring it goes is you can actually be in a situation where, let's say you're married and you pass away. All of the tax brackets get chopped down for your surviving spouse, and they are subject to something called the widow trap, the widow penalty, where this situation, you can look over on the left here, during their working career, they were in 10 and 12% brackets. Once RMDs turned on, they got kicked up into 25% brackets. And then once one of the spouses pass away, the survivor is going to be in a 28% bracket. Okay. If they would do some active planning here, some proactive tax moves, they have the ability over on the left to take money out at 12 and 22% brackets today and over the next 5 years and save themselves tens and tens of thousands of dollars. Okay. So this is just one tax example of understanding that at some point you need to leave your spouse prepared without you, and doing the things today that are uncomfortable to leave your spouse better off and protect your spouse. And by the way, these things that you do today, the conversions and different things like that, it's also going to help you while you're alive. So I kind of have this black dotted line on here that's showing how, you could basically chop your RMDs way down and have a lot more of your own income get taxed at more favorable tax rates, even while you're alive. So in a lot of these cases, having the estate plan benefits the heirs, benefits your spouse, benefits the charities and schools and wherever your money's going, because it's your money. And wherever it's going to end up, they're going to benefit from you having a better plan. But in many cases, you're also going to benefit from you having a better plan as well. So it's a win-win for everybody. As I say all the time, the only loser is the IRS. So that's how we want to keep it. But that's only one example of higher tax rates. You could actually, if you pass away without a plan, you could leave your heirs in a situation where they don't even get to use like stretch IRA rules. They're not even able to use the new IRA rules. They're not, we've seen people pass away, have IRAs get payable into a trust, and the amount of taxes that would cost them literally is six-figure amounts in taxes. And you want to have, it's just, to be blunt, it's too easy to do this planning. Okay. It's like two difficult conversations and you take care of all this stuff. Okay. Otherwise you can ignore it and it's always going to be there in the back of your head and have things come up after you pass away, just like delays, like nobody knows where your documents are. Nobody knows what accounts you own. Your money goes into probate. That's all held up. Probate fees. Okay. So like if you don't have everything squared away and your funds go into probate, there's going to be fees. Also, if somebody, if you go through probate, your estate becomes public record. There's a lot of people that don't want their financial situation being public record that anybody can just go in and look up. Also, if a will gets contested, that can leave some of your heirs not only delayed, but it could also obviously cost them getting that money. And also, even if it's contested and they successfully maintain their interests in your estate, it's going to cost you more money. There's going to be legal fees. There's going to be, and it's not going to cost you more money, of course, but it's going to cost your heirs, your spouse, the people in your life. They're going to lose out. You could also, if you have absolutely no plan here and you don't have like community property based accounts, maybe you have individual accounts or even like joint based accounts, you might miss a double step up in basis. That's something we talk about a lot that can lead to tens of thousands of dollars in extra capital gains tax that don't need to be paid. You got to have a plan. It's literally, you check a box or you send a letter and you now have double the opportunity to get a step up in basis. Also, if you pass away with no plan, management ceases. Okay, so here's what I mean by this. If you're doing it yourself, we see this every week, every month. Someone was very good at investing. Okay, and they end up with a portfolio of 20 stock positions and 10 big mutual fund positions, and they've amassed a great amount of wealth and they've done really well. They pass away. The spouse now is in charge of it. They have no idea what to do. Okay, so what happens? They just hold the stuff forever. They just hold the mutual funds forever. They hold the stocks forever. They have no idea that it's like you were thinking about selling it. They have no idea how the conversions work or how to minimize RMDs or how a QCD works or, any of the different things like that. And they just get left worse off. It's kind of like the Packers. If something would have happened here in the offseason, which it almost did, and he wasn't going to play this year, and Jordan Love comes in, it's like, look, I love, I want to give him the benefit of the doubt or whatever, but I would rather have Aaron Rodgers. And if Aaron Rodgers could like pre-make the decisions on plays and like literally where it's programmed in and everybody knows what's going to happen, I think that's a massive advantage. And with estate planning, you pretty much get to do that. You get to make some of these decisions even after you're gone. So you want to have a plan for this stuff. Lost assets. I can't tell you how many times we've been doing a financial plan for somebody and somebody gets all their information together and we go through and look and and we see an account get referenced that's not in their stack of statements, and we start asking about it, and come to find out there's whole accounts, $40,000, $50,000 accounts that just that spouse didn't know about, that son or daughter or brother or whatever didn't know they had it. We've already talked about tax rates. Ultimately, these bottom three are kind of the key ones. If you pass away with no plan, it's going to mean less money for the people around you, less money for your spouse, less money for heirs, less money for church, school, charities. Also, it could be a situation where the people that are left may be able to change your plans in a way that you don't like. So let's talk about that a little bit here. Obviously, you want to plan for this. You want to work closely with a financial planner. You want to work closely with an estate planner. Also, you want to talk with your loved ones. You want to have some of these conversations. Like one of the questions that we ask people a lot is, who's your backup quarterback? Something happens to you, Mr. or Mrs., primary financial decision maker. Who's the backup quarterback? And a lot of times it's like, oh, it's my oldest son. Okay. And my follow-up question is, do they know that? Do they know that they're going to be the one taking this over? And a lot of times they're like, oh, not really. We've kind of avoided the situation. Okay. And the third question, do they know where your documents are? Do they know where your will is? In a lot of places, they have to be able to provide an original signed copy of the will with 2 original witness signatures. If they don't know where that document is, your estate situation is going to be held up, and maybe assets are going to go into probate that didn't need to be. So do they know where your documents are? Do they know how to access your accounts? Do they know your passwords? Do they know this stuff? Because otherwise, you're going to leave the people behind that you leave behind, you're going to leave them way worse off. Okay, so if all you take away from this presentation is that you need to update your will and you need to get some powers of attorney in place, and just some really basic stuff like that, maybe even like a revocable trust, just to make sure that management stays intact throughout the entire process. You want to just take care of this stuff. Sometimes you're literally talking hundreds of dollars, $300, $500, $1,000 to save tens and hundreds of thousands of dollars down the road. In my opinion, I recorded a video a couple of years ago, I think now it's 4 or 5 years ago, where somebody asked me, I got $500. What's the best investment I could make with it? And I said, do you have kids? And they said, yes. And I said, do you have a will? And they said, no. And I said, the best investment you can make is a will. That's just for you. That does, it doesn't apply to everybody, but that's something that you really, really, really need to have, especially once you guys get up there. If you're in retirement and you've accumulated a lot of assets, I mean, a will is really the tip of the iceberg. But you want to have these conversations. Make sure the people around you not only know your plans and goals, but they know your intent. They know what you wanted. They know, the spirit of what you wanted to do, so that they're managing it in a way that there's already going to be so much stress around all this stuff when we pass away. That one of the big reasons that I have such a detailed estate plan, where I get made fun of sometimes even by Eric, with just how many things I pre-specify, but like there's going to be so much pressure on Kristen if something happens to me already, that I want to have things be as clear and easy and simple as they possibly can be. And that's why I recommend, if you haven't gotten this from us, shoot me an email, Tony@safeguardinvest.com. Again, that's TONY at the bottom, right on the bottom of the screen here, safeguardinvest.com. And we'll shoot you this over. At some of these questions, it's also reminders of things you want to keep with your documents, digital account passwords, something as simple as this, that some awesome people out there that are watching all these Wealth Wednesdays. One of the great suggestions that we got was, I would say 2 really great suggestions that we got. Number one is, when someone passes away, don't cancel their cell phone plan, because there's going to be times when the personal representative or executor is going through doing this stuff, that there's going to be 2-factor authentication, where a company is going to go, okay, we're going to send you a text to make sure that this is you and not some hacker. And you want to make sure that you're able to receive that text. Otherwise, everything defaults to like working in the mail and things get slowed way down. The other good one is, there's some really good password protection softwares out there like Bitwarden and some other things like that, where you can actually leave password beneficiaries. So what I mean by that is, you pass away, let's say you get an email once a month, or every 2 weeks, or however the frequency you set it, saying, hey, should we forward your passwords on to this person? And you say no. And then the next month you say no, and then the next month you say no, and then one month you don't respond because you passed away and your passwords get forwarded to that person. So there's a lot of different settings, a lot of different ways that you can do this in secure ways. The way that I recommend doing it is actually just hard copies of your various passwords, and then try to go in there and re-update it every once in a while, and make sure you have two-factor authentication so they can go in, change your password anytime, and they'll just be able to receive the text, and they're off and running. But let's keep moving on here, because in my opinion, this third one here, cognitive decline, is the hardest conversation for people to have. I actually just had this conversation about an hour ago, about right before doing this Wealth Wednesday, with someone that was mentioning to me that, he likes having someone there kind of looking over his shoulder. And right now he's super sharp, he's on the ball with everything, but he's worried about, hey, 10, 15 years down the road, family history stuff, there might be some things that pop up. And I think it's wise to be thinking about cognitive decline. There's this great study here. I don't remember if this was Harvard or Boston College, but this was a really big study where they looked at people all the way down to age 25, all the way up to age 81. And they looked at their abilities in a bunch of different areas. So the pink squares, that's inductive reasoning. Basically, think about that like logic. The blue diamond, that's spatial orientation. Okay. That's things like being very mechanically inclined and seeing how things fit together, or like if you're really, really good at chess, you probably have really good spatial orientation. And anyway, the green circle there, perceptual speed, just how fast and snappy things are up there. The yellow triangle, that's numeric ability, basically your ability to do math. I don't know if that's purple, but the purple square, we're going to call it verbal ability, and then the orange square, verbal memory. So two things that really jump out when you look at this. The first one is just overall, from age 25 to age 81, what is the general slope of the lines? Down and to the right. Okay, now the bottom of the graph here is not zero. Okay, so it's not saying that from age 25 to age 81, you lose 100% of your abilities. But let's take the pink square there, logic. You're dropping from a score of 60 on this test down to a score of 40. Okay, so that's a 33% decline in like logic and inductive reasoning abilities. The other thing that kind of jumps out to me is the numeric ability. So the yellow triangle, basically from age 25 up to about your mid 40s, your math skills are actually improving. So think about that right now. If you guys have been watching our Wealth Wednesdays and stuff, Eric's numeric ability is ramping up from here. Okay, his ability to do math and build software for us and all the awesome stuff he's doing is going to continue to ramp up and get better and faster and everything else that goes with it. But for the rest of us, I'm a little bit further along on that yellow line than he is. So I got a little bit here yet, but in the future, the big thing here, guys, this is something that affects everybody, every single human being. At some point, your capacity is going to be diminished. And it doesn't mean that, you're helpless or that you're not independent or that you can't take care of yourself. It simply means what I recommend for a lot of people is when you're in your 50s or 60s or maybe even early 70s and you're still pretty much with it, you should set plans in place, preparing for the inevitable. So what I mean by that is my estate plan. Okay, I'm in my 30s. My estate plan is extremely clear about how I am defined as incapacitated and what happens in that situation. Who takes over control of what? Who takes over control of like writing checks and stuff like that? Who takes over control of the investment decisions? All that stuff. And I hope that doesn't happen until I'm in my 80s, or maybe, we have awesome medical breakthroughs and it doesn't happen until I'm in my 90s. But at some point, I'm going to get declared incapacitated and the plan is already in place and I can't go back in and change that plan. Okay. So this is a really, really big deal. Like the costs of not paying attention to this are astronomical. Everything from the early signs of cognitive decline are like, oh, you forgot to pay a bill. You accidentally paid a bill twice. But then it kind of ramps up from there. You try to pull money from a closed account. We got really scared with someone that was a parent of a friend that tried to withdraw money for their taxes in like early April, and that account didn't exist. Okay, so they were like, oh yeah, it's going to be no problem. I'm going to pull the 20 grand needed for my taxes out of this account, and it wasn't there. Okay, and they had like 7 days to figure out how to get this tax bill paid or file an extension and everything else. But like that gets a little freaky. Okay, so you want to make sure that you're prepared for this stuff. Also, like this third one here, it's just kind of listed as just another bullet point. Overly risky investment doesn't seem like a big deal. It is a monstrous deal. Okay, if you're in your 80s or 90s and you have all of your money in Tesla because you're experiencing some cognitive decline, one of the interesting things that happens with cognitive decline is kind of the opposite of what you think. You'd think as they cognitively decline that people would want to be safer and safer and more conservative. It actually tends to go the other way. Okay, as cognitive decline happens, they start to become higher risk appetite, more risk loving, not thinking as much about the future, much more like, oh, this seems cool, this seems fun, I'm going to buy some of this. So you want to make sure that there's someone that has what we call a statement of investment policy, that understands your investment goals, your philosophy, how you think about risk, types of investments you don't want to own, different things like that. So that one day, if I'm sitting down with you and you ask me about buying a Chinese battery manufacturer, and I look down and for the last 20 years in a row, you've told me you don't want to invest overseas. You don't want to invest specifically in China. You don't want to invest in like tech startups. I can go, okay, maybe we need to start having some conversations about, the bigger picture here. And I think it's really important that even if it's not us, even if it's not Safeguard Wealth Management, even if it's an accountant or an estate planning attorney, or even just a trusted friend, you got to have somebody there that has the ability to put things in motion to protect you. Because at some point, this is going to affect everybody. If there's going to be a day where I'm cognitively diminished and really compromised in terms of my decision making, and I hope that that's way off in the future. But I'll tell you this, just from doing this on my own. When I say doing this, I went out and I hired an estate planner to help me draft all these documents, put these incapacity terms in place, all these different things. I felt so good after we did all this, knowing that I couldn't hurt myself due to cognitive decline, knowing that if something happens to me, this estate toolbox, all this stuff is in a bag, in a set of documents that my wife knows about. She knows how to use them. There's instructions in there, like letters of instructions of what to do, how to access different things. I'm not even talking about life insurance here. I'm just talking about being prepared. And when you have in retirement, what we find is a lot of people, when they turn, say 65 and they retire, there's kind of this feeling of like, oh, okay, I did it. I won the game, and the hard decisions are behind me and things. And it's, guys, I know you probably don't want to hear this, but some of the hardest decisions are just beginning. Okay, some of the decisions about all the tax planning and all that stuff, and where to pull funds from, and how much to convert, and how to set up my estate plan, and all that stuff is one thing. But then getting into like, what's going to happen if I cognitively decline? What's going to happen if my ability is reduced by 20 or 30%? How are we going to handle this? What are we going to do? And I think, at the end of the day, I hope that none of this was like offensive to anybody. I just really am passionate and believe that these are some of the most important items to address in a financial planning situation is all the stuff that comes with it. End of life planning. We didn't get into long-term care in here very much. I'll probably make a separate Wealth Wednesday about that. Definitely another difficult conversation, but this cognitive decline, it's coming. It's going to hit everybody. It's going to hit me. It's going to hit Eric. Someday my little 7-month-old daughter is going to be cognitively declining. So it's like, you got to be prepared for the inevitable and not just ignore it, not just hope it's going to go away. So there is no better time to address these things than right now. If you're watching this right now and you're 75 years old, this is the best possible time to deal with this. If you're 60 years old, this is the best possible time to deal with this. If you're 30 years old, this is the best possible time to deal with this. Okay, you want to make these decisions right now. You can always leave yourself outs, always leave yourself openings to be able to change and adjust and adapt the plan. Just always remember, you don't need more money, you need a better plan. I want to thank everybody so much for watching this. All you guys out there in Retirement Mastery on Facebook, love having you. We've gotten some awesome feedback. I mean, even just today, I've had 2 different people tell me how much they've learned on these videos. And, I have probably about half a notebook full of stuff from when Eric does his Wealth Wednesdays. And I'm just glad that we're putting out great information. If you have any questions about any of this stuff, or if I misspoke, or you think I got something wrong or whatever, I appreciate any feedback you have. Put it down below in the comments on Facebook. If you're watching this on YouTube, hello to Safeguard Wealth Management, all the subscribers out there on YouTube. That's been just blowing up like crazy. And we've been talking to a lot of you guys. And I'll give a special shout out to Budman. You're awesome. It was really fun talking with you. And I appreciate everything that all you guys do out there. And I hope we're adding value every week when we do these. And as we continue to make videos in the future, if there's anything really like putting pressure on you that you think maybe we might be able to help with, let us know. Drop us an email, tony@safeguardinvest.com. We might make a whole video just about that question, because if you're wondering about it and you're thinking about it, I bet there's thousands of other people out there on our YouTube channel and out in our Facebook group, Retirement Mastery, that are probably thinking the same thing. We're just really here to add value and try to help put you guys in as good a position as possible so that you and your heirs and the churches and charities and all the people in your life that you care about are left in the best position possible. And like I said, the only one that gets hurt, hopefully, is the IRS. So thanks so much for watching. And always remember, you don't need more money. You need a better plan. Thanks, guys.